I'm Kals, and welcome to The Comparable, the series in which each episode spotlights two companies building similarly in two different emerging markets. The Comparable is our love letter to the innovations coming up in truly hard places and the founders and investors making them happen. In this episode, we're doing another Comparable Compact, which is our series within our series, where we focus on one guest instead of two for a deep dive into their business or market. For this episode, I wanted to spotlight Brazil. For those who track, follow, and invest in emerging markets, Brazil is kind of the North Star. With a population of over 214 million people, Brazil is considered one of the top performing startup ecosystems in Latin America and arguably across emerging markets. In 2025, Brazilian startups attracted over $2 billion in funding across 363 deals, representing 52.9% of all Latin American venture funding. It also is a strong hub for fintech in the region, hosting 59% of LatAm's fintech startups. It's also home and headquarters to around 30 unicorns, which are companies that are worth $1 billion or more, like NuBank, iFood, Gympass, Creditas, and more. My guest today was an early believer and investor in the Brazilian startup ecosystem and has backed 6 of those unicorns, including some of the names I just mentioned. Rodrigo Baer is the co-founder and managing partner at 14B Ventures, an early-stage venture capital fund that invests in startups in Latin America. And in our conversation, we get into his perspective on the Brazilian market, as well as the LatAm region more generally, how it's evolved, what he's seeing work and not work, and the lessons you can translate to your market wherever you are in the world. Rodrigo is also my friend and classmate, part of the Kaufman Fellowship Program, and there are so many nuggets of wisdom in this episode, so I'm excited for you to listen. Let's get into it. My guest today has been investing in Brazilian startups way before it was cool to do so. Rodrigo Baer is the co-founder and managing partner at 14B Ventures, an early-stage venture capital fund that invests in startups in Latin America that are taking a B2B approach in AI, SaaS, fintech infrastructure, and healthcare platforms. He's also my Kaufman classmate and friend. He's a lover of Coke Zero. I learned this recently, and so I'm excited to have him on the podcast. Rodrigo, you've been investing as a VC in Brazil since 2010. First with Redpoint eVentures that invested in companies like Pismo, where you led their Series A and B. You sat on their board, and it was acquired by Visa for $1 billion in 2024. You then built out the early stage practice for SoftBank's LatAm fund and now run your VC firm, 14B Ventures. As someone who's seen and been investing in the market up close for over 15 years now, what's changed and what has stayed the same?
I think the what stayed the same is capital scarcity, and more important than scarcity, volatility, right? There are times where there's abundance of capital. There are times where there is shortage of capital. I think very much about Latin America as being at the beach. When the tide goes out, it completely leaves us out of the water. When the tide comes in, it floods us. So there is a lot more volatility and capital availability. What changed is that for the first time we have experienced people around the table, right? The market's still big enough. Brazil itself is 220 million people. Latin America is 600 million people. It's half of the population of India and China, twice the population of the US, much bigger GDP than Southeast Asia. So as a whole, it is a sizable market to invest. But when I started investing, I didn't actually start investing at Redpoint. I had a fund before called Warehouse. There was nobody that had built and scaled a startup, right? I joked that at iFood we wanted to hire a marketing manager and we couldn't find one because nobody had been a marketing manager for a startup because there were no startups. You fast forward 15 years, we built $40, $50 billion businesses out of this ecosystem, and each of them trained 3,000 to 5,000 people on how to build and scale startups. So now we have a pool of talent on the hundreds of thousands of people that have done it. And they're coming back to do it again. Greater ambitions, much more assertive, much faster. So that's what's changing. And that's really what's getting me excited about this moment.
Yeah, I think that's so interesting. It's so similar to Pakistan, actually, because Really sizable market, fifth largest population in the world, 250 million people. And then also massive amounts of capital scarcity. I think the difference is that we're just now starting to see that, that kind of circular amount of talent of people that have come out of larger companies and are now coming into the startup pool. So super interesting. And I mean, for you were just mentioning this, right? I mean, you backed LatAm founders before their categories even existed and before they were, the quote unquote obvious bets, which is interesting because a lot of VCs love to pattern match, right? And you were doing it before there were patterns that even existed. So besides Pismo that I mentioned, other early bets you made were in iFood before that category existed, Rappi, Creditas, and more. You've actually been an early backer in 6 unicorns, correct me or update me if there's more now, which is a pretty crazy track record, especially for emerging markets. Hindsight is 2020, especially in VC. We love to talk about the things that, we wish we did or whatever. But I am curious that when you look back, what was the through line, right? I mean, for you, it wasn't that you were looking for patterns, but was there a similarity or pattern you noticed when you look back on it that was something that was maybe similar amongst the founders you backed early that you leverage today as an investor?
There are a couple of things, right? And any ecosystem is going to start with whatever.com for Brazil, for Pakistan, for Mexico. Reason for doing that is because it makes it much easier to raise capital. Right. If you're an early stage fund, a seed stage fund, and you know that you're going to have a Series A coming from the US or from Europe, it's much easier to sell them on, Klarna works in Europe, Firm works in the US. Let's do that for Brazil. Let's do that for Mexico. Let's do that for Pakistan. They already bought the thesis, the general thesis. Now they have to buy the geo. So it makes it much easier for companies to raise capital if they are a copycat of something that the investors have seen be successful, whatever success is defined in the startup ecosystem, right? The second aspect is a good-looking founder is much easier to fundraise. And what I call about a good-looking founder is a founder that a U.S. investor can relate to and can verify quality. A U.S. investor has no idea what ITA is. And ITA is the Caltech of Brazil, right? It's the Military Institute of Aeronautics. That's where all the smartest kids go, hardest engineering course in the country. But a U.S. investor has no idea what the hell ITA is. He understands Stanford, he understands Harvard, he understands MIT, he understands McKinsey, Goldman. He has no idea what 3G is, right? Which is the largest Brazilian private equity that owns Burger King and Budweiser, right? So the familiarity around names and brands will make it much easier for a U.S. investor that's going to do your follow-on investing to underwrite that founder. So if you look, all the initial bets on every single fund is, I'm going to get a good-looking founder, right? A founder that a U.S. investor can vet, that speaks great English, right? People do not really want to understand a broken English. Doing a thesis that they have already seen. And that's how the whole ecosystem started. And honestly, that wasn't what I was excited about. I like the challenge of understanding a new business model and the intricacies. So that led me to a path where the founders that I ended up backing weren't what everybody else was backing. Good and bad worked for me, but that was important, right? So I did a lot of original businesses because I was curious about not doing copycats, but what else could be interesting about doing being built. And what I discovered later is that I got lucky, because if you're a copycat, you're a fraction of the reference company by definition, right? It's very hard to overtake them. I think the one exception is Mercado Libre, that became bigger than eBay. But when you are an original company, then you're the one getting copied, right? It's the story of Gympass. Gympass, Cesar created a company, and then he was copied in a company called ClassPass in the US. By the way, Gympass is like 3x the size or 5x the size. It's an amazing company. So that really got me excited. And that's where I decided to focus. As far as founders go, what really worked for me, and that's my personal bias, is founders that really are analytical, metrics driven, because that's how I think and how I can relate to them. I know there are investors that like a great storyteller, a great salesperson. I also love them. But to me, that's secondary to somebody that really looks at the metrics of this business and understands what's working, what's not. I think that gives them a faster cycle that enables them to change the business more often.
I think that's a really interesting point. I think when you're talking about the copycatting, I mean, that happens across emerging markets, right? Because we have to be able to bring in international VC money. And when you mention like the Klarna of or the Uber of, like we've talked, this is actually a pretty common theme in our podcast. Like the last episode, we talked about the Uber of trucking and how that had to change in order for those companies to get deeper and survive. And then even the example
at CargoX?
No, I talked to Cargon in Georgia, but it's very similar, right? Like these are all very similar models, and Truck It In, which is in my portfolio. But as an example, we did do a Buy Now, Pay Later episode, that last episode of our first season, and we spoke to Pagaleve. And it's a really great example of like when you look at that first wave, and I actually talked about it in the episode, it's like you look at that first wave of Buy Now, Pay Later, and everyone was like the Klarna of X. And the reality with emerging markets where there's like a lack of data, a lack of like real formal credit, you have to really build. And, you know, Pagaleve was so unique because they built off of Pix, which we're going to talk about in a little bit, but also they're the counterpart on the episode in Pakistan. There's no data, right, to build, you know, credit ratings. And so how they did it was so unique and different that the Buy Now, Pay Later plays that originally came up in that Klarna for X all died because the approach was too copycat. And the ones that survived were the ones that were really able to kind of dig into the nuance and meet users where they are, right? Because oftentimes users aren't ready to be, you know, to be that kind of sophisticated user that is often, you know, what we're copycatting to begin with. So you mentioned earlier about capital scarcity in Brazil today. In 2021 and 2022, like there was a period in emerging markets. Brazil was like kind of the pinnacle of this, that there was a massive amount of international VC activity. Pakistan was actually part of this as well. And it happened to us really for the first time, right? And so, you know, with interest rates being down, liquidity being high, COVID was happening. So people felt much more comfortable making deals over Zoom. You know, that boom in Brazil was pretty like sizable. And then there was a reset, right? As it also happened in other emerging markets everywhere. You know, there was a lot of macroeconomic issues that were happening. What did that boom, and you've kind of mentioned it a little bit, but I want to kind of dig into this a little bit more. What did that boom and the reset teach founders and investors generally? And then what are some of the lessons that you've taken away?
I think there are two stages of that boom in Brazil. At first, it was filling up a gap, a void where later stage capital simply didn't exist. So you had a bunch of companies that were ready to raise $150, $200 million and just never had that chance, right? Companies like Gympass, companies like Creditas, companies like Quintandar, companies that were ready for it and had postponed that fundraising because there was nobody writing that check. And that was the first wave, which was very beneficial because it showed that companies that if they had the money, they could scale globally, they could continue to grow at the pace that they had grown up to that. Then by the time that inventory was eaten up and fully funded, investors just started to move down and do the same rounds, the same capital deployment into companies that were not yet ready. And that became very detrimental, right? And Brazil is a little bit different from the rest of Latin America in that sense, because Brazil started it back in 2010, 2012. That's when the ecosystem here started. So you had founders that had lived through booms and busts, had seen capital come and go. So if you're looking on average, the Brazilian founder was more used to the availability and scarcity of capital, was much more disciplined about using that capital, right? If you look at companies like Olist, like Frete, they're basically sitting on all the money that they raised in 2021. They haven't spent much. If you look at Santiago at NuBank shop, he's sitting on a few $100 million that he raised in 2022 and just didn't spend. Whereas if you look at the ecosystems in Colombia and Mexico, where they started in 2018 and they had only seen up to the right, those founders actually took that money and burned through it with the assumption that there would always be money. So it's much more painful, the adjustment in those markets, than it is in Brazil, Argentina, even Chile. Chile never had money. So the founders there, when they raised, they were very disciplined about spending that money. So I think those are different stories. And the vast majority of the Brazilian unicorns are still around. They haven't imploded. Some of them have price adjusted, but honestly, it's a much better scenario than the other markets because we had institutional experience that to know that it was a moment and it wouldn't last forever. I think now the other markets, people are starting to learn how to build on a more disciplined manner.
Did it impact, I think that was what we saw in Pakistan too. It was just this concept of that VC money came with a mindset of growth at all costs. And it's about that top line volume rather than bottom line economics. And so was Brazil really good about staying, for the most part, right? You obviously had some models that were being invested in, B2B e-commerce was really big, all of those models that were so difficult to get the unit economics right versus businesses where from the get-go, they were always disciplined about cost and becoming cash flow positive, all those things. Is that something that you witnessed more in Brazil than elsewhere?
Definitely. And honestly, there were business models that were funded that simply didn't make sense. And they were funded because a US investor wanted to fund them, right? If you, let's take B2B marketplaces, right? Which were all the rage and raised boatloads of money in Latin America.
Tons of money. Yeah, same in Pakistan.
The problem with B2B marketplaces is that normally logistics is 6% of cost. And taxes 18, 19%. And in Brazil and Mexico, this is different in Colombia and Chile. In Colombia and Chile, tax collection is much more efficient. But for the small distributors in Brazil and Mexico, they evade taxes. So if they're evading a fraction of taxes, which are 18 to 20%, and you're trying to make up on a 6% logistical gain, you can't really make that math work. You're never going to be able to compete in price. And for somebody sitting in the US, which assumes that there is no tax evasion, that doesn't know how it's operated, he will underwrite that, not knowing that it's not going to work. It's for the local business, the local VCs to say, look, it doesn't make sense because you're competing with people that are not competing at equal footing. So that's one. The other one that I love is the buy now, pay later, with very few exceptions, and PagLeve is one of them. Everybody was like, oh, let's do Affirm and Klarna for Brazil. It's it doesn't make sense. That product exists in Brazil since the 60s. And it was done on pen and paper at Casas Bahia, and every single credit card in Brazil, every single one, and everybody in Brazil has a credit card, has 12 installments free of interest. So what's the use case for a buy now, pay later? There are very few restrict cases where it fits. And if you're not here, if you never went through a checkout on Mercado Libre and they offered you 12 installments free of interest, you have no idea. So adjusting things for local reality is key. And a lot of things were funded that simply didn't make sense.
Yeah, and sometimes the good-looking founders, they talk really well, but maybe they don't understand their market realities as much, right? And that's a sweeping statement because there are,
or they understand, but they're selling what people are buying, and then they're going to try to figure out a way of making it sustainable along the way.
Yeah, and that's come up a lot in this podcast. So you were mentioning, we were talking about PagLeve. They built off of Pix, which is Brazil's instant payment system. I find that model so interesting of like being able to build on the rails of that infrastructure and what, as a result, like companies are able to do. And I want to kind of touch on that digital public infrastructure efforts by the Brazilian government. It was a huge unlock for, your digital transformation, for the whole markets, like infrastructure, and especially fintech infrastructure as a whole. In Pakistan, our DPI efforts, have been recently like picking up, and our instant payment system has similarly went live over the last few years. So I'm curious about what you've learned watching and investing in Brazil through this period of that transformation, and what other emerging markets can learn from Brazil's efforts around that digital transformation.
Perfect. No, so I think most people overlook this, but the Brazilian government has made an immense digitalization push, right? If I have to file my taxes, it takes me 5 minutes. I go to the website of the government, they have all my incomes, they have all the information from the banks, all my expenses. I just have to verify, click 3 clicks, approve it, and submit. The level of control that the Brazilian government today has over the Brazilian economy is very high. And it goes across the board, right? I go to the US every now and then, and I forgot to take my paper driver's license because my driver's license is now on my phone. All my documents is on my phone with the Brazilian government. And the rest of the world hasn't caught up to it yet. It comes from a massive budget constraint that doesn't allow the government to hire more people. They have to digitalize, otherwise the government's gonna freeze. But that's a bigger question. But they've pushed a massive amount of digitalization, right? And Pix is a particularly important one. And the beauty of it is that they understood market forces, right? When you're competing against a credit card that has universal acceptance, right? Any product that does not have a universal acceptance, it's not going to fly, right? It's a much worse product from the client's perspective. And the Brazilian central bank did something that for the US would be unheard of, but they mandated every single banking institution to actually adopt Pix, embed into their app, and basically that ensured universal adoption. And once everybody has it, then it makes usage skyrocket.
You've mentioned this a couple times already in this chat, but you talked about Brazil being large market, scarce capital. Silicon Valley valuations are climbing, but you mentioned this in a LinkedIn post recently that the arbitrage is still in Latin America. I know that's your thesis, it's your pitch for what you're building at 14B Ventures. Can you expand on that a little bit more of, why the arbitrage is Latin America? And just on that note, because obviously Latin America is not a monolith. How does Brazil as a market compare to the rest of the region?
I think Brazil is given the stage of development of the ecosystem, it's very different from the rest of Latin America. In Brazil, you have second-time founders. In the rest of Latin America, you're still in the first generation and still dealing with the overfunding that happened 21, 22. So those markets suffer more. Also, the Brazilian market is a lot more liquid for exits. 84% of exits of Brazilian VCs actually come out of Brazil. So the other markets do not have that history of exits yet because they're still in the first cycle, right? And also the other challenge is how many companies in these markets are worth $10 billion plus. Because if the incumbents are not worth $10 billion plus, it's very hard for them to write $1 billion check. So you have, if your incumbent is worth $1 billion, yeah, maybe he can buy you for $100 million, but not much more than that. So the Brazilian companies are bigger. The Brazilian banks are bigger than the rest of Latin America, and that creates M&A availability, right? So that's a big aspect there. The other thing, and this has been growing on me, is that context drives what you're building. And Silicon Valley builds for the Silicon Valley. And what do I mean by it, right? Every company in the US is externalizing an API. Great. If you have a developer on the other end. And that's the reality in the Valley. That's not the reality in 95% of the world. The world does not have a developer. And it's not Brazil. I'm talking about the steel mill in the middle of Tennessee. They don't have a developer. And somebody needs to develop for the non-Silicon Valley client. So I think there are a lot of things that are going to come out of the non-Silicon Valley markets that are going to cater to the vast majority of the world. And then in our context, for example, you mentioned Frete, right? The freight, the Uber for trucks. It doesn't exist in the US because the US in the 80s went to centralized dispatching over call center. Then in the 90s moved on to GPS dispatching. The gap from GPS dispatching to cell phones, not really material. In Brazil, in Pakistan, in China, we're competing with a post-it on the gas station wall. And that gap from the post-it to the cell phone is massive. So this is an innovation that needs to come from somebody that's leapfrogging the US evolution, right? So I think there are things that will come out of here that will eventually make sense. Not only in Brazil, will make sense in the US, will make sense globally. Fraud, conversational. It's insane that the US banks still use an SMS to do two-factor authentication. Every Brazilian bank just scan your face. And why are we using SMS when SIM cards can be copied? It's insane. So there are around fraud, security, conversational, right? How do I do e-commerce and conversations? In the US, it's impossible because everybody's on freaking iMessage and Apple blocks it. On WhatsApp, you can do it. As WhatsApp picks up in the US, who are going to be the providers of conversational banking, conversational e-commerce? We had 10 years more experience than the US players will have by the time this picks up in the US. I think conversation is going to be a big topic for what we've been doing in LatAm. So all of those are opportunities that I think come out of LatAm, come out of Brazil, and will have global impact. And when I'm buying at LatAm prices and selling as global companies, then my multiple will kill every multiple that you can get in the Valley. Will I build bigger companies in the Valley? Yes. Will I build bigger multiples? Not at the price people are paying.
Right, exactly. Like the entry price is so high. Just to dig into the Brazil versus the rest of Latin America part of the question, how, oftentimes, like we've seen companies that have scaled across LatAm. Obviously, you've backed Rappi. You were talking about Mercado Libre earlier. Those are obviously giant companies now. But how hard or easy is it for a company operating in another country in Latin America to scale to Brazil? And do you think it's easier the other way around, just given how much depth and complex the market is in Brazil?
I think changing countries is very, very hard, no matter what. And I think for very few cases, it actually justifies going from Brazil to Mexico. The economies are structured different. The way you do business is different. And I'll give you a good example, right? Rappi worked extremely well in Colombia. When I invested in the seed, the model was
so you invested
beautiful.
when they were in Colombia.
I invested when they were thinking about coming to Brazil.
Got it. Okay.
So if you go to Colombia, you have the office buildings and you have a bodega right underneath it. And what they did, they created this hyper-local model where they would put somebody in the blocks of corporate buildings, and the guy would go from the small stores underneath it, basically on a 4-block radius, and do 7 deliveries an hour, because he could walk from Starbucks to the mini market to whatever, to the pharmacy, and pick up things for you. And he didn't, to walk 4 blocks, you don't need a bike, you don't need a motorcycle.
Because the density of users is like right there. Yeah.
And that same setup exists in Mexico. When you come to Sao Paulo, it ain't so. The business buildings do not have a bodega or a little market in the bottom. And when they came to pitch me, I said, well, guys, your model's not going to work here. You can't do 7 deliveries an hour. Go figure out how you're going to adapt the model for Brazil. There are things that can be done. And all of a sudden, an investor in the US that didn't really understand the difference, the geographical difference between Mexico City, Bogota, and Sao Paulo, gave them $45 or $50 million and told them to scale. And guess what they did? They scaled. But they scaled in a model that doesn't work in Brazil, because in Brazil, distances are long. So you needed a motorcycle, salaries are higher, and the guy doesn't do 7 deliveries an hour, he does 2.5.
So the unit economics get impacted pretty dramatically. Yeah.
Things don't scale. They don't translate. It's not because we speak the same language or a similar language that they will go well from one market to the other. And founders should really think long and hard. What's my next best market? And is that something that's worth going? Because your next best market, next easiest market might be Bolivia. But Bolivia is not going to help you in volume, and it's not going to help you in exits, right? Winning Paraguay doesn't really help your case of exits. It's probably better to get to win in Florida. And that increases your exit opportunity tremendously. So thinking about the upside of each different market and how hard is it going to be. If you think Gympass started in Brazil, and then they tried Mexico. They figured out that Mexico's freaking hard. And then they said, well, let's go easy. And they decided to go to Europe because the benefits culture in Europe is much greater than in the US. Then they won Spain, they won Italy, they won France and Germany, and then they went back to the US. So how you plan your expansion is key. You need to be smart about it.
That's super interesting. Last question is, we'll make the answers kind of fast in terms of how you're thinking about things. You've kind of mentioned a little bit about this, but what are the things you think are overhyped right now? What do you think is underhyped? And what do you think deserves the hype? So overhyped first. What's overhyped?
A bunch of companies that only exist because of an irrational dynamic in the valley. Look, paying people $20 million is not sustainable for the long run. And give them $20 million of budget to acquire data without a procurement process to ensure that that price makes sense. It only happens because there's so much money going in that that people can afford to do it. But at some point, markets are going to adjust. Markets are going to be rational again. And if you're building your company, assuming that each developer in the valley is going to be able to spend $20 million a year in acquiring data from you, that's going to be tough. You are in for a rude awakening. You should obviously maximize the fact that that's happening and use that to generate cash flows in your business. But you have to build a business that eventually assumes that anomaly in the market is not going to be there, and how do you make it sustainable? So I think there are a bunch of things that only make sense because of where the market is with AI and this excessive hype, right? And excessive amount of money going into it.
What's underhyped?
I think people are still... So banks are still sitting on 1960s infrastructure. Everybody has a mainframe with COBOL running on it. Like, that's the biggest industry in the world. People need to redevelop that technology. And getting old technology business and rewriting it to modern technology, to me, is a massive opportunity. What's going to happen with the utilities? What's going to happen with telecom? What's going to happen with airlines? What's going to happen with banking? How do we move these people from an IBM mainframe with COBOL into bleeding edge technology? Because now they're going to be competing with NuBank. It's not that JP Morgan is going to be competing with Wells Fargo, both sitting on the same 50-year-old technology. They're competing with NuBank, which is sitting on 2020 technology. And it's not only the cost, it's going to be time to market. And I think helping the incumbents to redevelop that, to me, that's the biggest opportunity that nobody's looking at.
Great. Last question. What deserves the hype? There are things that are being hyped. What deserves it?
I think AI is obviously going to create an insane amount of value. It's how do we push from testing? It's never been easier to test and to do a POC with an enterprise. In 20 years, I never seen it. Like today, you raise your hand and say, I have an AI solution. Any enterprise is going to test you. How do we move that from testing to production at scale is an interesting question to me.
Yeah. We're living in very exciting times right now.
Exactly. AI is exciting, the potential of what it can be done. Questions are around what's the deal to be done around that makes sense and provide the adequate returns.
Great. Thanks so much, Rodrigo, for joining me for this episode. It was filled with tons of nuggets, lots of really interesting takeaways for me personally as an early stage investor in Pakistan, lots of things that I'm learning too. So thanks so much. And thanks for being here.
Thank you.
That's it for our episode with Rodrigo as we talked and dug into Brazil and more generally the LatAm startup ecosystem as well, but a real focus on the Brazilian market. And I hope you learned as much as I did. I think, as you can probably hear in the episode, I have to rein myself back sometimes because there's just so many similarities to, I've been working in Pakistan for now over 15 years and in the startup space. And there's so many similarities and lessons that you can glean from what Brazil has already experienced. And I think one thing that's really interesting is that when the amount of VC activity that happened across emerging markets in 2021 and 2022, Brazil probably experienced the most amount of funding, arguably across emerging markets. Pakistan also had a similar boom. And then that reset happened, right? And I think what's interesting listening to Rodrigo talk about it is because Brazil has been around for longer, there's been a couple of those cycles. So founders were a little bit more sophisticated. They knew what to do with that money. They also were, from the get-go kind of aware that reset could happen. So they were thinking about that in the medium term. And I think that's really important for a startup space to be able to survive through the downs as well as through the booms, and for founders to act responsibly and with the money that's given to them, right? Because with emerging markets, like scarcity can happen, funding can dry up so quickly. So really the founders that win are the ones that are able to weather through the storms, not the ones that are able to raise funding when it's cool to do so. I love that piece of it. I loved listening to the piece about the founder sophistication in the market because of the successes, the fact that Brazil has had 30 unicorns. So what those unicorns end up breeding, and we saw this with Kareem in the region, in the Middle East region, is it breeds more founders, right? It breeds people that have been able to build companies at these large companies and are able to then take those lessons into becoming founders themselves. And I think that cycle and that flywheel effect is something that's made Brazil really unique and also just a really great North Star for anyone building anywhere in the world of like, what can we learn from those playbooks? It's obviously not like for like, but there's a lot of really important lessons and a lot of things that translate really well. So thanks for listening. Please like, subscribe, and share wherever you listen or watch your podcasts. And I'll see you next time. Bye.